What if the S&P 500 crashes? It's a great time to buy assets, sure, but what if you just retired? A drawdown can force you to sell assets at a loss, and that's never good. Today we're going to look at what happens if the S&P 500 crashes and what you can do to preserve your wealth. So let's first start by defining what the S&P 500 is. It simply represents the 500 largest stocks that trade on major U.S. exchanges. Now, the S&P 500 is a commonly used benchmark and a proxy for the United States. And here you can see the top holdings in the SPY, the popular S&P 500 ETF. It's understandably tech heavy because all these names have been running lately. You see at the top there Apple, Microsoft, Nvidia, Amazon, Meta, and Google. So when you see the breakdown on the right there, information technology accounting for nearly 31% of the sector breakdown. There's 11 sectors, right? So they should all be less than 10%. But 56% of exposure is actually in three industries. That's information technology, financials, and healthcare. And when we look at the performance of MSCI USA, so MSCI USA standard is simply large caps and mid caps. So based on the research that I looked at, the S&P 500 contains about 80% of MSCI USA exposure, minus mid-caps. And what's interesting about the U.S. is that it's significantly outperformed the rest of the world. And here you can see that on this chart, MSCI USA at the top there, below that MSCI World. So when you add in the developed market countries of the world, ex-USA, it drags down performance quite a bit. Now, that's not likely to always be the case, but that's worth noting. Also, when we look at MSCI ACWI, so that's simply all emerging markets and developed markets, we see that the performance gets dragged down even further. So the key takeaway here is that the S&P 500 and U.S. equities are highly correlated. So we might also ask the question, what happens if the U.S. markets crash? Well, as they say, when the U.S. sneezes, the world catches a cold. And here you can see the breakdown there on the right of MSCI ACWI. As I said, that's all countries that are emerging or developed. And you can see the United States makes up 63% of global equity. So I always liked MSCI ACWI because it's 99.5% of the investable universe. In other words, it's all stocks in the world. Of all stocks in the world, the United States makes up 63%. So you can imagine that if there's a crash, the S&P 500 crashes, the U.S. is consequently crashing and the rest of the world is going to respond accordingly. Now, what's important to note here is this concept of correlation, and it's quite simply this. You notice here they give this example of asset classes. So an asset class would be stocks, bonds, real estate. The reason they use asset classes and not assets is because within an asset class, the members of that universe typically behave in the same fashion. So in the United States, if the entire U.S. market takes a dump, then most stocks will also take a dump. So if you have an asset class A that rises 10% and another asset class that does the same, they're said to have a perfectly positive correlation of 1. But if asset class A rises 10% and asset class B doesn't move at all, then they have no correlation. They're not related. Now, if asset class A drops 10% and asset class B rises 10%, they have a perfectly negative correlation of -1. So that's important to note when you consider a portfolio that holds differing asset classes. And this correlation matrix is just an example of one of many that you'll find out there. You see how the S&P 500 on the right is correlated 1 to itself. So that's expected. Then you see on the left there, global, I've highlighted that, has a 0.98 correlation. Well, when you look at what makes up global, they simply have, I believe it's MSCI ACWI. And then when you see international equities, just 2 there to the right, you see 0.87, it drops. That's because they're using MSCI EFA, and that's ex-USA. So the point to make here is that differing asset classes will have differing correlations, and you need to pay attention to the time frame. So you see here it says historical correlation January 2013 to December 2023. So that's 10 years. Well, what's interesting about REITs is that if you increase duration when you're looking at correlation, they actually become less correlated to stocks. So they have a great diversification effect to keep in your portfolio. The other thing to consider is how countries are correlated. So half of our audience is ex-USA. So here you can see how different countries are correlated to one another. This is a great tool that MSCI provides. Up there in the upper left, you see Canada is green. So that pure green, that's actually being compared to itself. So correlation of 1, right? And below that, you see USA. So that's also green, but not as dark. That's because it's highly correlated to Canada. And then you can go down and see how countries respond to one another. What's interesting there, and towards the bottom of this chart, is that red line across. That's Pakistan. It's negatively correlated, it appears, to everything except itself, which is rather interesting. So when we consider the S&P 500 crashing, I wanted to talk about 3 profiles of people who might respond differently to this. So first, you have individuals starting their investment journey, let's say age 21 through 30. They're dollar cost averaging smaller amounts. They can afford to take lots of risk. But as I always tell these people, that it's best to have some percentage in safe assets simply so that you can benchmark your own performance. So if 95% of professional managers can't beat a benchmark in the long run, you're not likely to either. And the sooner that you realize that, the better, so that you can get on with the slow and boring process of creating wealth. Then you have those in the middle of the journey. Let's say they're 35 through 50. They're dollar cost averaging larger amounts. They probably learned some key lessons about wealth creation. They're prone to taking lesser risk as time goes on. Then you have people towards the end of their journey, let's say retired folks, 60 or older. 95% or more of their money is put to work, and 30 to 50% drawdowns are going to cause them to understandably lose sleep. Now, for all of these people except the third category, they benefit a lot when the markets fall. That's the beauty of dollar cost averaging. So if you're investing and on a regular basis and the markets fall, you're upset because your portfolio is down, but you're happy because you're buying assets for quite cheap. If you have a decade or more left to invest, then a market crash should be welcomed. That brings us to the average time it takes for a market to recover. We're going to talk about that. Now, investors who are already retired or at the tail end of investing, they are going to need to sell assets when they're down. That's a problem. So what sort of drawdown could we expect if the S&P 500 crashes? Well, we can look at past crashes, and this is quite edifying. So up to a 57% loss. And we're not talking about a single stock. We're talking about an entire benchmark here, the 500 largest stocks in the United States. So I think lots of people haven't felt pain in the markets because they're just not old enough. But I wanted to focus on the retirees. There are a lot amongst us, and they always have questions around what to do when there's a crash. Well, obviously you keep producing income for as long as possible, but if that's not an option, then perhaps you've already started down the 4% rule. So that says if you're a retiree with $1 million, then 4% of that is $40,000, and you should be able to take from your savings $40,000 a year and never run out of money. Now, the problem is that if you have a 30% drawdown, your wealth is now $700,000. A 50% drawdown takes you to $500,000. So suddenly things aren't looking so good if you divide $500,000 out by 40,000 and say, wow, I've only got, 12 or so years before I run out of money. So there's several options that you can use here. There's something we refer to as the new 4% rule, which is simply taking 4% of your total assets every year, regardless of whether they're up or down. And obviously that amount's going to be variable. So when it's lower, you cut back on spending and you budget better. Take a holistic look at your assets and trim what's taking the least hit. So what most people don't realize, they always talk about income. And I know there's tax implications here, but let's just keep it simple. Any asset can yield 5%. You just sell 5% of it every year. So if you look at this example here, it's very edifying. It shows somebody with $500,000 in 2002 and what happens to that money over time if they use the new 4% rule. And that yield column there, that's simply the yield of the S&P 500. So this is SPY, S&P 500 ETF. That income represents the yield, of course, that's reinvested, and they simply trim at the end of the year 4%. So you see that first year they trim $25,000, and the second year $27,000, you see. And then you see that dip in 2008 when the market dumped 37%. So that 1 year, presumably they could dip into savings there or trim off something that wasn't absolutely destroyed and make up that difference. But what's fascinating here is look at the top line. So they started out with $500,000. They're using the new 4% rule and trimming 4% of that over time. Their income's going up. The cash flows, I should say, that's cash going into their pocket. And look at your principal in 2023, $1.7 million. So your principal is appreciating and your income as well over time, and you're in no danger of running out of money. So that's an approach that you can take. Now, people often ask, well, how long does a bear market take? If the S&P crashes, how long will it be until it recovers? Well, this chart by Investopedia I think is very useful. It shows the length of a bear market in months in blue and then the length of recovery in yellow. So the entire cycle of a market crash can last up to 90 months or 7.5 years, or it can happen very quickly as it did with the recent quote-unquote crash around 2020 with the Rona. Now, the way to avoid losing lots of money in a market crash would be to invest across various asset classes. And this is a picture of our own asset class allocations. You can see on the left, most of our money is in Quantigents, and I wanted to talk about that for a second. So that's our dividend growth investing strategy, and it works extremely well. Look here in this first column where it says portfolio average 46 years. That means that the average company in our portfolio has not only paid a dividend, but increased it every year in a row for 46 years. And in our universe, the average is 43. Our portfolio is slightly larger than that, and you can use our tools to create your own DGI portfolio. But what that means is that these firms have managed to continue increasing their dividends through some very rough times like the dot-com crash or the 2008 crisis. And if you could imagine losing 37% of your assets, so a DGI strategy is going to mimic the returns of the S&P 500. Those ours outperforms in a paper that we did. If you're a premium subscriber, reply to any email we send, and we'll send you that paper on the performance of our DGI strategy. But imagine your assets losing 37%, and all the while that's happening, your income keeps increasing. That's very appealing for investors. So I just wanted to point to this great quote by Peter Lynch. He says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Don't jump in and out of the market, try to figure out when there's a bear market or not. Just keep to your same strategy. Now, there's those people that will latch on to a sacred cow, and they'll have all their assets or most of their assets in a single tech stock that they then discuss perpetually. Now, let's forget about company-specific risk for a second. Have you considered the concept of beta? Beta simply says this. A stock with a beta of 1 is going to move in the same fashion that the market does. So the market falls 50%, the stock's going to fall 50%. A stock with a beta of 0.5 will move with half the volatility. So if the market falls 30%, your stock falls 15%. And a stock with a beta of 2, of course, multiply that. Market falls 20%, your stock falls 60%. So you might ask the question, what are the most volatile stocks in the S&P 500? Well, there's actually an index for that, the S&P 500 High Beta Index. And look there at the top, the usual suspects, right? NVIDIA, Supermicro, you've got Tesla there. So it's important to note that NVIDIA with a beta of 1.76, if the market falls 30%, NVIDIA is going to fall 53%. It's going to trade at around $54 a share. So it's realistic that that might happen. Tesla, a beta of 1.58, market falls 30%, Tesla falls 47%, trades at a share price of $109. So keep that in mind when you're tempted to invest in a single stock or overweight any stock in particular. So the last proper market crash, that was 16 years ago, and it was the Rona. That didn't really count. If you're under the age of 33, you weren't even old enough to smoke during the last market crash, you probably didn't learn too much from it. So most of today's newbie investors, that means nearly all of Robinhood's accounts, haven't felt the pain of a crash. And when they do, the phones start ringing. Even with institutional investors, when I worked at MSCI, when we had that big crash of 2008, you can't believe the pandemonium. Our MD simply said, guys, get on the phone and talk to clients, reassure them, right? So even proper experienced investors get quite upset but when the market crashes. Whatever you do, don't sell assets during a crash. You buy them. And if you're holding crappy companies, then you should worry a lot. Hold quality assets, dollar cost average, and let the market do its job, or let time do its job. Here you can see 5-year chart for S&P 500. And you see that massive buying opportunity of August 2024 and the Japan carry trade? Yeah, I don't either. So that was simply a tiny blip. When the market actually crashes, then you're going to feel feel some pain. Now, if you're just starting your investment journey, you better hope and pray for a bear market that lasts for decades. Now, if you're halfway through your journey, just change nothing, but make sure you understand your risk exposures, understand correlations. If you're towards the end of your investing journey, it makes sense to diversify across asset classes because crashes often happen slowly. And as I said, trying to time the market is a fool's errand. Manage risk in a manner appropriate to your age, and you're going to be just fine. Now, we get these questions all the time. Joe, you said invest in good companies. Where can I find good companies? Well, we discuss them all the time, and you'll find that there's more to life than just Tesla. So I've put up this piece here on how to find great quality companies that will not only pay but increase their dividends over time, even during market crashes. Make sure to give that a watch. Thanks so much for taking the time to watch this today.